So, how do you really get a look inside a multi-billion-dollar energy giant? I mean, to understand their strategy, their challenges, and their true performance beyond just the headlines. Well, you go straight to the source, the official report card they publish for the whole world to see. See, every quarter, public companies like TransAlta have to release this incredibly detailed report. It's basically a guide to their inner workings. It's a direct line to what management is thinking, what's going well, and, just as importantly, what's not. And today, we're going to decode their latest one. The key to all of this is a document called the Management's Discussion and Analysis, or just MD&A. Seriously, think of it as our window into TransAlta's world for the third quarter of 2025. It's the company's story, told in their own words. So let's peek through that window and see what it tells us. Okay, so first things first, what does TransAlta actually do? I mean, to make any sense of their financial numbers, we've got to start with the fundamentals of their business, right? And listen, this is no small operation. We're talking about a massive company that owns and operates a huge variety of power plants. And they're not just in Canada, they're all across the US and even way over in Western Australia. Their sheer scale makes them a major force in the global energy market. Now, this mix is absolutely key to understanding them. Look at this. Over half of their capacity, 54%, is from natural gas. But, and this is a big but, nearly 30% comes from wind and solar. This isn't just some old-school fossil fuel company. It has a massive renewable footprint, which is then balanced out with hydro and what they call energy transition assets. This whole portfolio, it's central to their entire story. Okay, here is a super crucial detail for understanding their money. TransAlta sells power in two main ways. Some of it is sold on the merchant market. Think of it like a farmer's market where prices can swing wildly from one day to the next. The rest is contracted. That's sold at a fixed price over the long term, kind of like a subscription service. This blend of risk and stability is fundamental to their whole strategy. And here's that balance in action. Just over half, 51%, of their power generation is locked into those stable, long-term contracts. This provides this really predictable foundation of revenue, which, let me tell you, is a critical buffer when that open market gets volatile. All right, so we know what they do and how they sell it. So how did all that translate into actual financial performance? Let's dive into the numbers for the third quarter of 2025. Okay, right away you can see a pretty clear trend here. Revenues are down a little bit compared to last year, but the bigger stories are right here. Adjusted EBITDA, which is a really key measure of profitability, is down significantly, and the net loss has actually gotten wider. This is the core of their Q3 financial story. Let's just focus on that one number for a second. Adjusted EBITDA dropped a whopping 24% year over year. For a company of this size, that is a major move. And it really begs the question, exactly. A 24% drop does not happen by accident. So what gives? Well, fortunately, the MD&A breaks down for us exactly what happened. According to their own analysis, it was basically a perfect storm of factors. First, those merchant assets we talked about, they got hit hard by lower power prices in Alberta. Second, their energy marketing division, which trades energy, saw lower gains. You add to that lower revenue from their hydro plants and higher operating costs, and boom. You've got all the ingredients that drove down profitability. But a financial snapshot is really only one part of the story. It tells us what happened, but not what the company was actually doing during this period. And as it turns out, they were making some pretty big moves. Just look at this timeline. It shows that even with a tough quarter, TransAlta was playing the long game. They were busy managing debt, extending their credit lines to stay flexible, and making tough calls, like temporarily shutting down a facility because of market conditions. They also sold off some assets, and this is a big one. They announced a CEO succession plan. See, these aren't just random events. This is a company actively trying to shape its own future. Okay, so that covers the past and the present. But the MD&A also requires the company to look ahead, to talk about the biggest challenges and uncertainties they see on the horizon. And they start with a really important disclaimer. This quote right from the report is a friendly reminder that the future is never, ever guaranteed. These are their best predictions, sure, but they come with a whole host of risks. So what are those risks? What's keeping their leadership awake at night? Well, at the very top of the list are those fluctuating power prices that hit them so hard this quarter. Then you've got changing environmental regulations, the real physical risks of climate change, and of course, intense competition for new contracts. On top of all that, there are the bigger economic headwinds like inflation.
This is the incredibly complex landscape they have to navigate every single day. So, when you put it all together, the diverse energy mix, the financial pressures, those big strategic moves, and all the risks looming ahead, you see a legacy energy giant caught right in the middle of a massive transition. And it all boils down to this one critical question. In an energy world that is changing this fast, can a company of this size and history really pivot quickly enough to win the future? That, my friends, is the billion-dollar question.